All right, folks, welcome to Investing for Beginners podcast. Today we have episode 374. Today we're going to answer 3 great listener questions we got recently, and we'll just kind of start diving in. So here we go. So this is a great one from Reggie, who is in our Value Spotlight community. He said, "Hi, Dave. I wanted to ask you something that intrigued me while I was reading Peter Lynch's One Up on Wall Street. In chapter 12, Getting the Facts, pages 196 and 197, Lynch discusses cash and long-term debt and applies a dollar value to the share price per net of cash. Later on, page 200, he examines Ford's cash position and finds in the glossary that Ford's leasing units earned $1.66 per share in 1987. By applying a PE ratio of 10, he values this segment at $16.60 per share. I find it fascinating how Lynch broke down the share price into these components. Have you ever used a similar approach in your stock analysis? If so, how can an investor effectively replicate this model? I'd love to hear your thoughts, as I found this method quite insightful and potentially useful." Again, this is Reggie from the Value Spotlight community. So great question. So what are your thoughts on Reggie's question?
Yeah, I think of sum of the parts valuation.
Mm-hmm.
That's basically what it sounds like to me.
Yeah, that's exactly what I took away from it as well. So would you like to listen to or explain to our fair listeners what a sum of parts is?
Yeah, you're basically, rather than trying to look at what's the whole value, what's the whole business worth, the value of that, you're saying, I'm going to look at this piece of the business, that piece, and value them all separately as if they were their own businesses. And then you're going to combine what your estimate was for each of those parts. And then that's going to be the valuation for the stock. And that's kind of how you come up with that. I think Berkshire, people do that with Berkshire a lot, right? Yeah. You're kind of the Berkshire expert. So I feel
right.
Like what you take, right. Take it from here.
Expert, we're going to use the term loosely when we refer to that, but yeah, that's pretty common to use this kind of analysis to look at companies like a Berkshire Hathaway. Banks are a real good one to do it with as well. Just any sort of conglomerate or companies that have lots of moving parts or pieces that are kind of a challenge to value alone. Some companies like Berkshire, because of the nature of their business, they have insurance, they make money from an investment portfolio, they make money from wholly owned businesses. It makes it really hard to do a DCF with a company like that just because of the nature of the business. And banks can also be a challenge with that because of they make money from various different sources. And so using something like this can be very effective. It's also a great way to look at, if you're looking at a company of, not to pick on Ford, but maybe to pick on Ford a little bit, if you were to, let's say the company went to zero or could potentially go to zero, then maybe that's not the right way to say it. But if the company was liquidated, then you would look at something like this as, how do I value the individual pieces or the assets that people would buy? Bruce Greenwood, am I saying it right?
I think it's Greenwald.
Okay, sorry. Thank you. He's really good at kind of using this net asset value kind of idea or sum of parts as a way of trying to value companies, because you look at try to estimate the value of the assets of the business, and if they had to sell those off, what would those be worth? And so to me, that's what Lynch was referring to. Is this something that you use in your process?
Me personally, no, I don't. I'll look at, like, if I'm estimating a growth rate for a company, I'll look at each segment differently. Mm-hmm. If I feel that different segments are going to have different growth rates. So like to use Alphabet for the millionth time on the show, I did a valuation for them. A Google search estimated like a conservative growth rate, and then YouTube estimate conservative growth rate. And because both of those have a lot of operating profits, then it bakes into the free cash flow down the line. But that's definitely not some of the parts, I don't think.
You're right. No. Well, I mean, it kind of sort of is. Maybe for the millionth and one time, if you are looking at when you're doing something like that, this is definitely a tangent, but bear with me for a second. If you do something, a blended idea like that, you take different parts of the company and you look at the potential growth rates for those individual, do you then kind of weight them by the percentage of revenues that that segment each generates, or do you just kind of average them all together?
No, like I'll literally take a spreadsheet and then, so I'm using exact numbers. And then if I say 7%, I'm taking YouTube's profits growing over 7%, taking Google search profits growing over 7%. So the spreadsheet's doing all the heavy lifting.
Right. Okay. That's smart. That's really smart. Yeah. This is not something I use. It's a tool I'll use when I look at something like Berkshire Hathaway or Markel, or, some of those more conglomerate-ish type companies. When GE was a thing, I know a lot of people used the conglomerate or a sum of parts to value a company like GE. It would probably work really well with Johnson & Johnson, but it is something, if you find this interesting, it is definitely a tool you can use it for any company. So it doesn't have to just be, the 2 or 3, and you can use it for Meta if you wanted to. Maybe that's a fun 500th time we've mentioned Meta. All right. So let's move on to the next question. So when you track portfolio performance, do you calculate it based on the stocks you own, or is it free cash flow also included? For example, if you had 80% in stocks and 20% in cash, and your stock portfolio doubled in 1 year, are you considering this as a 100% increase in your portfolio? If cash was included, this number would be less than 100%. I'm curious how you derive your portfolio performance.
Asking me or you?
I'm asking you.
The listener is asking me. Well, I'm 100% invested at all times, so my cash is negligible. But yeah, I'm calculating performance on even that negligible cash.
Right. This is maybe a more mechanical question. When you're looking at your portfolio performance, is it something that you look at on your browser, or do you have a spreadsheet, as the spreadsheet ninja on the show? Do you have a spreadsheet that you use to help kind of keep track of it on a monthly, daily, weekly, however much you look at it basis?
When I'm looking at the one I publish for the newsletter every month, that has multiple spreadsheets, and that's a tangled mess, and it usually takes me about an hour to get through it all. But I'll just take like what's in my brokerage, because I had, long story short, it's in 2 brokerage accounts because for some reason you still can't do partial shares in Ally Invest. But it's crazy. Like, I don't understand that. So Fidelity is nice because you can do partial shares. So I opened a Roth with them. And so I have the 2 Roth accounts, which make up the real money portfolio. So I take those balances, put it in the spreadsheet, and then I have all these checks and balances to make sure the numbers are correct. And as far as like on a daily basis, a cool little trick you can do if you like to see how your picks are doing generally over time, and if you don't want to use like a portfolio tool, I mean, there's plenty out there you can find, and they can link up with your, you can create a portfolio in their tool. But if you like Google Sheets, you can do a function called Google Finance, and then put the ticker in there, and then it will automatically, I think every 15 minutes, it'll update with the stock price in your Google Sheet. So you can kind of play with the spreadsheet however you want to be able to see, any stock's price at any given time, which is kind of.
Yeah, that's cool. How do you account for dividends?
So if I'm doing it for the newsletter, it's automatically included in the portfolio balance that the brokerages are giving me. In the spreadsheet that I use, a Google Sheet, I add dividends to the stock price, and then that gives me the return.
Gotcha. All right. And then how do you deal with like the drip part of it? Because you're not only getting the dividend, but it's also buying a share or percentage of a share. So how does that all kind of automatically calculate?
That's a great question. So for the Google Sheet, I just don't have that. So I know that my actual returns are a little bit higher than what my Google Sheet's telling me.
That's nice, isn't it?
Yeah. Well, I guess for me, as a newsletter provider, it's not so great because people look at my returns and think it's, they see it lower than it actually is. But yeah.
Yeah. How, this is maybe kind of off topic a little bit, but how often do you check your portfolio? You obviously have to update it once a month. Right. Are you looking at it every day, every hour, like once a week? It's like whenever the mood strikes you?
I don't know if you do this like on Twitter or anything, but like, when you get just downtime and you're like, I want to check something and you don't want to open your email inbox. So you like check your Twitter account or check like a obscure Gmail account or something. I do that for my portfolio. So I'll go to Seeking Alpha when I'm bored and I want to check something. And that's usually at least once a day.
I feel you, because it's less energy spent. If you go into an email, then there could be more energy that needs to be required to either read or respond to said email. Whereas if you go to Seeking Alpha to track your portfolio, that's literally just opening an app and looking at something.
Yeah.
There's not a lot of effort that needs to be expended. I know our friend Andy talked about this. Do you have your brokerage app on your phone?
I do now, but I don't. It doesn't make me make impulse decisions.
That's good.
So that's good.
That's really good. So this is maybe, interesting question I just thought of. When you buy your monthly pick, do you do it through the web app or do you do it through the phone app?
Yeah, through the web.
Through the web. And you do that because it's easier or just because it feels more, I don't know, real?
I saw a meme about this and it was completely ripping on my generation, which is the millennial generation. And it said, you're millennial when you go to the computer to do important tasks like buying a plane ticket or, in my case, buying a stock. Or I guess like the Gen Zs and younger, they just do everything on their phone. But like for some old like me, I have to be sitting down on my desktop or a laptop to do something important like buying a plane ticket because I don't want to screw it up.
Yeah, you are speaking my language because I am so that person. If I have to do something like sign up for a website, I have to go, I can do it on the app. I know I can, but it just always feels clunky. I thought it was just me and the fact that I'm just old and a fuddy-duddy or something, but okay. It's good to know that it's not just me.
Yeah, you're not alone, buddy.
Okay, that's good to know. I certainly felt like, okay, it's just because I'm just old. Let's move on to the next question. So how do you handle bad news related to your investments? For example, the CEO of Intel was recently fired/retired and the company dropped. How do you deal with news like that? And how do you deal with news maybe related to a specific industry or sector or company that you're investing in?
I'd be curious your thoughts, and maybe you could walk us through the Intel thing, because do you still own them?
No, I dropped my bag a while ago.
Oh, okay.
Yeah,
well, good. And the bad news was not bad news for you.
No. Well, I had already lost, I don't know, a good 60, 70% of my investment. So I paid my price. For those of you not familiar, first of all, Intel is a semiconductor company here based in the US and very important to our future as far as having the supply chain of a very important product, semiconductor chips here in the United States. It was the leader for many, many years and has since fallen on very hard times. And the recent CEO, who was actually one of the architects to creating success at Intel many years ago, he left and went to another company and recently came back to try to help revitalize Intel. He announced that he retired, but the board of directors gave him a choice of either quitting or being fired. And so he chose you can't fire me, I quit kind of thing. So he is left the company and they basically dumped him because the share price has been in the tank for quite some time and it's only gotten worse since he's taken over. And he was trying to basically turn around the Titanic. And as Warren Buffett likes to say, turnarounds don't often turn. And so we all know the history of the Titanic and how that turned out with turning. So anyway, if you owned Intel and you saw that the leader of the company who you were basing all your future hopes and dreams on left the company, that was not a great sign.
No. So you're saying the news article depends on like the type of news makes a big impact on how you would feel personally as a shareholder in a company.
Yeah. A company like Intel is an interesting beast. I read this article from a guy named Doug O'Loughlin, who writes Fabricated Knowledge. He's one of, air quotes, semiconductor gurus out there. And he wrote a pretty scathing article about the board of directors for the company. And basically a lot of the people that have been in power on the board of directors for the last 15 years or so, he feels like are directly responsible for what's happened to the company. And one of the things that was interesting was, since the company has kind of started its decline, it's gone through 3 or 4 CEOs in the last 15 years or so. And each one of them progressively, kind of dropped the ball. They missed on mobile, they missed on AI, they missed on GPUs. So they've had some fumbles for sure. And the news of him being fired in this particular instance, if I own the company, I probably, it was doing so badly, I would have been so negative, that may have caused me to sell out of the company if I hadn't been before. It just feels directionless at the moment. And if I was still a shareholder, I probably would have bailed on it if I hadn't prior to this.
Sort of like a 5 strikes, you're out kind of thing.
Yeah, for sure. I mean, how do you feel about bad news? Like if bad news hit Apple, Tim Cook left, or something maybe not catastrophic, but something bad came out that they were buying chips from China or something. I'm not saying that's bad, but I'm just trying to throw out specific examples. How would you feel about that?
It's a good question. And, if you're a newer investor, I think it can be a little bit overwhelming because there can be so many things that you could perceive as negative news and you might not know how to handle all of it. So the first piece of advice I would give somebody who was trying to navigate this as a newer investor would be to use something like bamsec.com, BAMSEC.com, or even just only focus on a company's investor relations page, and in particular, the 8Ks that a company posts, because that's your filter. That's your way of differentiating from, Jack, Susie, and Debbie's opinion that, they typed up in their mom's basement about a company like Apple versus real developments that are happening inside the company. And so if you can stick to official documents, that gets you closest to the source. And just by doing that, you can automatically tune out all of the noise. Because trust me, if you want to find an opinion about something about some company, especially at a size that Apple is, you will find that opinion. Confirmation bias is very real. It's alive and well. So if you don't want to be so overwhelmed where you feel like you don't know who you can listen to, sticking to something close to the source, like an 8K is the way to go. And I'm just going to throw this out there because it's not really my thing. Not saying that I'm doing this on purpose or anything, but it's just where my portfolio is today. I don't really have any owner operators I can think of other than maybe Watsco that are coming off the top of my head. So for me, if a CEO leaves, usually the companies I have, other than Markel, CEO doesn't really play that big of an influence. I mean, they all do. Obviously, anybody can make a really bad mistake, and if you're at the top of a company, it's going to have consequences. There's going to be reverberations. But the difference is, like, if somebody's an owner operator and everything rides on this one guy, my investment style just doesn't have companies like that. So I don't get, when I get a little pop-up that says on my 8K, this person left as CEO of Visa, or this person left as CEO of Costco, both of which things happened in the last 2-3 years. It didn't affect me personally because I bought those stocks not for owner operators, but because of Costco's moat and Visa's moat.
Mhm.
So that's why for me, those type of news events don't affect me.
Yeah.
But there could be other news events that would maybe affect me more and worry me more. But CEO thing does not generally.
Right. Yeah. So what you're saying is if you hear some bad news, don't go on Twitter because that's all you'll see. So you're saying stay away from Twitter. That's probably a good thing. Yeah. 8Ks are kind of this is something that you kind of clued me into was, reading 8Ks. And I feel like it's an unhidden, not unhidden, like a unfound jewel of information that you can get about companies that I don't think is talked about enough. Like I subscribe to about half a dozen companies. I subscribe to their investor relations page. And so they send me everything and anything that comes out of the company, which sometimes can be a little overwhelming, especially with all the Form 4s that you can get with companies. Oh, yeah. That can be a little overwhelming. But like perfect examples, today I got news from Visa about their Visa Direct service and how they are basically making it effective that if you use it, you can have your money in your account within 30 seconds of somebody sending you the money. And as somebody who's interested in how that may play out in cross-border payments and business and all those things, I found that really fascinating. Most non-payment geeks would be like, yeah, okay, whatever. But as a payment nerd, I was like, oh, that's awesome. So, this could be something, this is something that I know as Visa has been promoting and pushing for quite some time. And so it will, at some point, I think it will have a material impact on Visa's performance. And so it's good to be updated on all that stuff. So you mentioned that maybe because of the way you have your portfolio structured, CEO news is not really something that's real high on your list of things what would be high on your list of things that might not terrify you, but maybe give you pause if something happens?
It's a great question. So I dealt with this recently in probably the last few months. A company in my portfolio, we'll see if they remain by the end of the month, had an 8K talking about how they had to halt production, and it was related to weather and things like that. And so some of these businesses that are more reliant on factories and things like that, that can be a huge impact. And so that definitely worried me. I think Northrop Grumman's impairment might have been in an 8K as well. So sometimes they'll call out certain big things that you'll see in the earnings call, but they might also just highlight it for you, which was, I appreciated that was something brought to my attention so I could be aware. Yeah, things like impairments, maybe a company makes a bad investment or they fumble the ball with their costs on something and it makes a business or a project just not profitable where they thought it was going to be. Those type of things would be information that, okay, if this company has a track record of doing that, or if it's what I perceive to be a signal that their moat is deteriorating, those are the types of things for me as a long-term investor that would make me kind of raise my eyebrows and be like, okay, I need to spend some time here.
Mm-hmm. Yeah, for sure. If you're listening to a earnings call, how would you feel if there was some bad news and management basically chose to ignore it?
Yeah, I mean, obviously not good, depending on the scale of something. Yeah.
Mm-hmm. Yeah. I have heard that in the past from some companies, and definitely left a sour taste in my mouth. Like, okay, if I was considering investing in them and they chose to be that blind, then or maybe not. That's maybe not the right way of putting it. That not upfront about potential problems and how they're going to solve them. That to me is a big red flag. In some cases, you could tell sometimes how big of an issue it may be if every single analyst on the call asks them some version of the same thing about the problem. That's also, to me, I've seen that a few times where, okay, this is probably bigger than I maybe really thought it was.
Yeah, that's a good one. Yeah, that's a really good one.
let's say that you do come across some news that maybe is not fortuitous, shall we say? How would you deal with that? Do you have, maybe briefly we could go over a few maybe sell ideas or sell rules that you have to kind of in place to help maybe act as checkpoints or speed bumps to make sure we don't overreact to something?
Yeah. So a few I've had for a while is if, because I buy a lot of dividend paying stocks, if they cut their dividend, that's a good signal. If they go into negative earnings for the year, that's a good signal. And then watching their balance sheet too can be a good signal. But I think having those in place definitely helps. We've talked about this before. I can't remember on which episode, but I feel like I don't want to speak for you, but I think I am correct in saying that you and I buy similar companies in that when we buy something, it's for the long term. And so we have that luxury of taking our time to evaluate if something has changed. We're not buying an AI startup where somebody could have disrupted them yesterday. We generally buy things that are longer lasting, have these moats that protect them for a long time. And so because I have that kind of longer, the type of businesses I buy just don't tend to change all that much in a short amount of time. I have that luxury of taking my time to assess what everything has gone on. Unless I'm trying to raise cash, that's a different story.
Right. And then that's a different story. But yeah, you're speaking my language. Yeah, we generally tend to buy companies that have stronger competitive advantages and are less susceptible to overnight innovation or overnight disruption, which can definitely happen. Like you said, the startup AI company that came out with a brand new thing and 3 weeks later, somebody else has got it better and faster and stronger. We don't play in that sandbox. So that helps avoid some of the knee-jerk reactions that can happen with definite, bad news. The one big bad news that always kind of comes back to mind, and I'm not really sure why, maybe it's because I just didn't take advantage of it, is when Netflix announced that their subscriber count had dropped, or maybe it hadn't dropped, but hadn't improved for the first time ever. And so the company dropped like 20% in one day. That's really the worst news, and not the worst news, but news that I definitely remember thinking, I should try to take advantage of this.
I didn't.
I didn't either. I didn't feel like I knew enough about why they dropped, and I didn't really understand, their mechanism for that. I'm not saying I do now either, because I really haven't done much work on it. I will say that their 10K is delightfully short, is nice when you're used to reading bank 10Ks. So that's nice. But I think generally bad news is something that you have to be aware of, but I think you have to understand what game you're playing, what sandbox you're playing in, and how you want to react to those things.
Yeah, very well said. I feel like there's a lot of wisdom there.
Hopefully. Hopefully it helps.
Thank you for all the questions today, everybody. I hope that was helpful. I hope you learned something. Take action today. Connect, learn, and grow with Value Spotlight. Peace.